Welcome back, traders and investors. We have Kate Stalter on the line. She's an investment advisor at Portfolio Wealth Advisors and columnist for Forbes and Real Money. She is a big fan of technical analysis. Kate, how are you doing this morning?
I'm doing great, Joel. Thanks so much for having me on.
No, our pleasure. So, give us a little bit of your market and your education background, and kind of how you ended up in these crazy markets.
Yes, absolutely. Yeah, yeah. I was a trading coach for many years. I had the privilege of working with the terrific crew at Investors Business Daily. I think that's where a lot of people in the trading world kind of originally got to know me because I taught trading seminars around the country and I did videos on their website every day. And I got to tell you, it is such a privilege to work with Bill O'Neill for so many years. And
Wow.
I just learned a lot from that guy. Yeah, I was there 10 years. So it was awesome. And then from there, I went on. I did a lot of videos for Money Show, moneyshow.com. I'm sure a lot of your audience knows that site. Met a lot of fantastic traders and people with great ideas and great business models. Really, that was a really pivotal moment for me, Joel, because I got to broaden my horizon and learn some more about the long-term investing world at the same time that I was interviewing a lot of stock traders. And to be quite honest with you, it really, really opened my eyes. I have no problem with people who want to run some kind of stock trading portfolio or maybe options, writing some covered calls, whatever your option strategy is. No problem with that as long as you allocate that to a small part of your portfolio and really concentrate the bulk of your financial resources on diversified, balanced retirement portfolios that you understand what the expected return is and you understand what your portfolio does for you. To sort of be I had a couple epiphanies, Joel. If you're interested in hearing about what those
Oh,
are.
always. We're all about epiphanies on Benzinga's pre-market prep. Go ahead.
Okay. Well, one of the things that I really started to notice, having come from a background as a trader, was I was looking at a long-term chart of Apple, and this was a few years ago, not recently, but I think it would still apply. I was looking at a long-term chart of Apple, and I said, you know what? If you had not tried to do what I was doing, which was trading in and out of this thing, using technicals, using some rudimentary fundamental analysis, if you had just held on to this thing, rather than putting yourself through all the anxiety of trying to trade in and out, look where you would be right now, very far ahead. You would have had to sit through some corrections, that's fine, but you really would have been net ahead. So that was one of the epiphanies I had. And the second one really was just kind of looking at figuring out what your money needs to do for you. Because when you ask a lot of people, what's the purpose of investing, they'll say, oh, to make money. Well, that's only half of the answer, Joel. The real answer is it's designed to, the reason you invest is to create income to meet your future obligations. So in other words, you and I are both in our working years right now. Trust me, at some point in time, I know this from working with clients, everybody says, I'm going to take it easy now. I've had enough of this going to work every day. I want to just relax, spend time with my family. And when that day comes, you're not going to have that paycheck coming in anymore, are you?
No, no, that's correct. So, good advice there for the long term. Kate, I mean, working with Bill O'Neill, the best of the best, and learning technical analysis him from 10 years. I'm sure that's quite an experience. So, what to give us, the foundation of what he taught you, how you use it now, and kind of how you've expanded on your own.
Yeah, absolutely. One of the things that was just so wonderful to learn during those years was mastering the canceling system, understanding really the market dynamics. I think having gone forward, and I left IBD about 3.5 years ago. So in the last 3.5 years, I think what has stuck with me most has been just watching the market ebbs and flows. and understand. I'll give you a funny quote. One day, a number of us were sitting in a meeting, and people were kind of wringing their hands a little bit about the S&P and the U.S. indexes, because that's what IBD focuses on, is the U.S. indexes, the Dow, the S&P, the Nasdaq. Uh, I think that they were having a downside day, and people were kind of upset about this. And Bill just looked around the table at everybody in the meeting, and he said, "Well, they can't go up every day." Now, that seems pretty obvious, but that was a really good lesson that I've taken with me. Is just, yeah, the market is going to ebb and flow, and then having gone forward now, becoming a licensed, registered investment advisor myself, and working with clients who are looking at their long-term portfolios to create income, you really do have to have the patience through these downside markets. The other thing, too, that over time, one of the things that I've really incorporated into my philosophy, Joel, is the fact that the U.S. represents about 50% of equity market cap. So that means you've got a whole other 50% of the world out there. And I think what happens too often with U.S.-based traders and investors, we focus on the U.S. only. And I understand that. We can be forgiven for that. Because if you turn on the television or you look at a market report, what indexes are you going to see reported on? Just the Dow, the S&P, the Nasdaq, pretty much. And then you have to kind of click through a little further to see what the foreign indexes are doing. So I think U.S. investors can be forgiven for not understanding that there's the rest of the world out there. But I will say this, it's absolutely crucial to diversify. To be a great example of this, people who complain, and it's not really a complaint, that's not fair, but people who talk about the fact that they suffered a lost decade due to U.S. market weakness between 2000 and 2009, yes, that's true for investors who were heavily concentrated in U.S. large cap. This may be shocking to you, Joel. Maybe you know this, maybe it won't be shocking, but between 2000 and 2009, of major world indexes and even major U.S. indexes, large cap U.S. as an asset class was down 9.1% in that decade. Other asset classes, both domestically and overseas, had as much as triple-digit gains. So people who were heavily concentrated in U.S. large cap, which is the stuff we're all familiar with, those were the people who suffered that lost decade. That's pretty stunning, I think.
No, that's great. Yeah, that's great statistics, and I was aware of that. I tried to be flat for most of that decade, and worked out good. Not so much since 2010, but just getting to your technical analysis here. Are you? I mean, what time frames do you look at? Do you look at? Do you get caught up in the shorter term charts, the 10 minute, the 15
Mm-hmm.
minute chart, half hour? Are
Mm-hmm.
you just not looking? I mean, I know some people that don't look at anything shorter than an
Mm-hmm.
hourly. Do you focus on the dailies? Where do you get your cues from?
Well, let me clarify something. I'm not trading anymore. I'm a long-term investor now. So,
Well, you
I
still look
did
at
use a
charts
lot of
though, right?
technical.
You still look at charts though, right?
Not too much. I really
Really?
don't use the technicals anymore. Nope. Because, you know why? Because for a long-term investor, and this makes people mad. This is a polarizing point of view. I understand this. I've spoken in front of groups of traders before, and it just makes them mad because they think, hey, wait a minute, you're saying you can do something better? Yes, I can. And I'm going to take a little long-winded way to answer your question here, Joel. But I don't know if you recall, maybe some of the listeners do. Back in October of last year, a gentleman named Eugene Fama won the Nobel Prize for Economics. And his research over the course of the last 50 years, actually, because he's in his 70s now, his research over the course of the last 50 years has been about efficient markets. And I'm sure some of your listeners are familiar with the efficient market hypothesis, modern portfolio theory. This is really what I've made a move to right now. I'm
Mm-hmm.
not trading stocks. My clients are in mutual funds, very inexpensive mutual funds, diversified globally. And the reason that we're doing this at our firm right now is because 85%, 85% of active managers cannot meet their benchmark in any given year. That's astonishing. I mean, the data are there. Now, I realize this, that, for traders, it's kind of hope springs eternal, and you're thinking, yeah, I can beat markets. Here's the problem that happens, though, is that people sometimes use the wrong benchmark. They'll say, well, I know a guy who was beating the S&P for the past 3 years. So, I'm just making this up, but that's the sort of examples I've heard. Well, yeah, maybe you were beating the S&P for the last 3 years, but you were trading small caps, so the S&P is the wrong benchmark to use. And yes, there's not always correlation between what you might see large caps doing or small caps doing. One thing that we do in our portfolios, Joel, is we know the research shows you want to tilt towards small cap and value stocks. Okay, not that you want to be all small and all value, because what happened in the S&P since 2009? Well, it's been fantastic in those last few years. So if you had not been in the S&P since 2009, that would have been a problem for you. But there really is trying to time the market the way active managers do. The data show it doesn't work. And I know that upsets people, but it doesn't work.
Just to throw a question out here from Cold Slug in the chat room, he says if 85% of the managers can't beat the benchmark, then why
Mm-hmm.
would you be in their funds?
Okay, great question. Great question. Yeah, active managers was the word that was left out in the question there. 85% of active managers.
Okay.
So really, you want to be geared more towards an indexed approach. Because the problem is, and again, there's data on this that we show our clients when they come in, is that on a yearly basis, it's really impossible to pick either what sector or what region of the world is going to lead or lag at any given time. It's kind of fun because I have these charts I show people, and it's sort of like a crazy quilt of just a bunch of different colors, and they'll represent developed markets in the world. And you can look at this, and you cannot pick out what's going to be the worst. The first thing that theory doesn't really work out. You can't pick out what's going to be the leading developed region at any given time or the lagging developed region. Same thing with the S&P sectors. We have a chart that's the same way there. You absolutely cannot pick out what's going to lead or lag at any given time. And the news, by the way, Joel, is not always your good indicator either. I think a lot of us are conditioned. I get it. We all are. We're conditioned to think, well, if whatever the pundits are saying about healthcare or energy or tech, doesn't matter. We can make our bets based on that. Well, it doesn't always work out. There's a funny article from March of 2009, and I cited it in a column that I just wrote for Real Money on the street. And what happened was March 2009. You remember March 2009
Yep.
when the market bottom, U.S. market bottom, started going up. There was an article from the Associated Press, 5 reasons why the market has bottomed and 5 reasons why it hasn't. So that was a kind of funny one because it was a great example of hedging your bet. But to me, it showed, well, yeah, there you go. You can make punditry arguments either way about any sector, any market, any region.
Okay, Kate, you are like you're opening up so many different things for discussion here. I wish we had a little bit more time, but we don't. I hope you can find some time to come on again here because I think you're really striking some chords here with people in our chat room. We'd love to have you back on again. So thanks a lot, Kate.
All right, Joel, thanks. I'd love to come back too. This is fun.
Okay, all right, thank you.